$2.3 trillion. That's what Amazon was worth at its peak in 2024. 2.3 trillion. Today it's down 30% from those highs. And folks, I'm afraid we're just getting started. A friend of mine runs a successful retail business in Nebraska, called me last week asking if he should dump his entire 401k into Amazon while it's on sale. Said his broker told him it's a once-in-a-lifetime buying opportunity, that Amazon Web Services alone is worth more than the current market cap. I told him what I'm about to tell you. When everyone's running to catch a falling knife, you'd better step back and watch where it lands. Because in my 95 years on this planet, 70 of them investing other people's money, I've learned that the biggest disasters come disguised as the biggest opportunities. You see, I've watched this movie before, 3 times actually. Sears in the 1,970 seconds, General Electric in 2000, and now Amazon in 2025. The parallels are so striking, it's almost eerie. Each time, we had a company that seemed invincible. Each time, Wall Street said it was different. Each time, investors lost fortunes believing the hype. Let me show you exactly what's happening beneath the surface at Amazon, why the real collapse hasn't even started yet, and what you should be thinking about doing with your money instead of catching this particular falling knife. Because the truth about Amazon isn't what CNBC is telling you. It's not what your broker wants you to believe. The truth is that Amazon has become the most overvalued, over-leveraged, and overhyped company in American history. And when this house of cards finally collapses, and it will collapse, it's going to take a significant portion of the stock market down with it. Now, before we dive into the numbers, and there are some truly shocking numbers to share, let me take you back to 1,999. I'm sitting in my office in Omaha, drinking a cherry Coke and reading about this online bookstore that's losing money on every sale, but supposedly making it up in volume. The stock had gone from $18 to $106 in 12 months. Analysts were saying Amazon would hit $500 by 2001. They were calling it the future of commerce. You know what happened next? The stock crashed 94%. 94%, from $106 to $5.51. If you'd invested $10,000 at the peak, you were left with $600. Sure, Amazon eventually recovered and became a giant. But here's what nobody talks about. It took 10 years just to get back to those 1,999 levels. An entire decade of dead money. And those who bought at the peak and held, most of them sold at the bottom, crystallizing massive losses. Fast forward to today, Amazon's trading at a price-to-earnings ratio of 43. That's 43 times earnings for a company whose retail business is barely growing. For comparison, when I bought Coca-Cola, it was trading at 15 times earnings and had much better growth prospects. The math simply doesn't work. But here's where it gets really interesting. Let me share some numbers that'll make your head spin. Amazon's retail operations, which still represent about 70% of revenue, grew just 2% last quarter. 2%. That's less than inflation. Their international retail segment actually lost $4.3 billion last year. $4.3 billion in losses. And this is supposed to be a $2 trillion company. The bull case rests entirely on Amazon Web Services, AWS, as they call it. It's their cloud computing division. And yes, it's profitable. Generates about $90 billion in revenue and $27 billion in operating income. Impressive, right? Well, not when you consider that Microsoft's Azure is growing twice as fast. Google Cloud is catching up rapidly. And now we have Oracle, IBM, and even Alibaba all gunning for market share. AWS's growth rate has decelerated from 40% 3 years ago to 12% today. Mind you, this is the crown jewel, the one thing keeping the whole edifice standing. When your best business is slowing down that dramatically, you've got problems. Charlie Munger, God rest his soul, used to tell me, Warren, show me the incentives and I'll show you the outcome. Well, the incentives at Amazon are completely misaligned with shareholder interests. Andy Jassy, the CEO, made $213 million in compensation over the past 3 years while the stock has gone nowhere. $213 million for treading water. The company has issued $42 billion in stock-based compensation over the past 5 years. That's dilution on a massive scale, folks. They're printing shares like the Federal Reserve prints money. But here's what really concerns me. The debt. Oh, the debt. Amazon has $135 billion in total debt and lease obligations. $135 billion. That's more debt than the entire market cap of companies like American Express or Starbucks. And they've been adding to it aggressively. $20 billion in new debt just in the last 18 months to fund their expansion plans. Expansion into what exactly? Grocery stores that lose money, healthcare ventures that they've already shut down, a satellite internet project that's years behind SpaceX. They're throwing good money after bad, and they're borrowing to do it. Now you might ask, but Warren, isn't Amazon dominant in e-commerce? Sure, they have about 38% of US e-commerce. Impressive. But let me tell you what's happening beneath the surface. Walmart's e-commerce is growing at 23% annually versus Amazon's single digits. Shopify is enabling millions of merchants to bypass Amazon entirely. Chinese competitors like Shein and Temu are eating into their market share with prices Amazon can't match. The moat is shrinking, folks. It's shrinking fast. I remember back in 1973, everyone thought Sears was invincible. Largest retailer in America, real estate portfolio worth billions, credit card business generating steady profits, trading at 50 times earnings because it was different this time. You know what happened? The stock fell 70% over the next 2 years and never recovered its inflation-adjusted peak. Never. Sears filed for bankruptcy in 2018. The invincible retailer was gone, and I see the exact same pattern forming with Amazon today. Let's talk about their latest earnings report because it's a masterclass in financial engineering. Revenue of $143 billion sounds impressive until you realize that $105 billion of that is from retail with margins so thin you need a microscope to see them. The retail gross margin is now down to 3.9%. 3.9%. That means for every dollar of stuff they sell, they keep less than 4 cents before operating expenses. My neighborhood grocery store has better margins than that. When interest rates were zero, maybe you could justify these margins. But with rates at 5%, with the 10-year Treasury yielding 4.8%, you can get nearly 5% risk-free in government bonds. Why would you accept 3.9% margins in a cutthroat retail business? Here's something Wall Street doesn't want you to know. Amazon's free cash flow, the real money available to shareholders, has declined 42% over the past 2 years. 42% decline while the stock price stayed elevated. That's called multiple expansion without fundamental support. It's exactly what happened to Cisco in 2000, to GE in 2001, to every bubble stock before the crash. The price stays high while the fundamentals deteriorate. Then suddenly, boom, reality hits. The trigger's already been pulled, folks. You just don't see it yet. Let me explain the 3 stages of Amazon's coming collapse. Stage 1, which we're in right now, is the growth deceleration phase. AWS growth slowing from 40 to 12%. Retail barely growing, international losing billions, stock price holding up on hope and habit. We're about 60% through this phase. Stage 2, coming in the next 6 to 12 months, is the margin compression phase. Competition forces AWS pricing down. Retail margins go negative as they fight to maintain share. The stock drops another 30 to 40% as reality sets in. Stage 3, the capitulation phase, 12 to 24 months out. Major restructuring announced. Tens of thousands of layoffs. Possible breakup of the company. Stock touches $800, down 65% from the peak. Now the bulls will tell you I'm crazy. They'll say Amazon's different. It's not just a retailer. It's a technology company. It's an infrastructure play. It's the backbone of the internet. I've heard it all before. You know what General Electric bulls said in 2000? It's not just an industrial company. It's a financial services giant, a media conglomerate, the most valuable company on earth. The stock went from $60 to $6. Took 16 years to restructure and recover, and it never got back to those highs. Let me tell you about competitive dynamics because this is where things get really ugly for Amazon. Microsoft spending $60 billion a year on cloud infrastructure. Google spending $50 billion, Meta $35 billion. Oracle just announced a $100 billion infrastructure fund. Every major corporation in America is building their own cloud capabilities. The U.S. government just announced a multi-cloud strategy explicitly designed to reduce AWS dependence. When your biggest customers are actively trying to reduce their reliance on you, that's not a growth story. That's a decline story. And then there's antitrust. The Federal Trade Commission has an active case against Amazon. 37 state attorneys general have joined. They're seeking structural remedies. You know what that means in plain English? Breaking up the company, forcing AWS to separate from retail, making the marketplace independent from the logistics. This isn't some far-off possibility. The trial starts next year. Even if Amazon wins, the legal costs and business disruption will be enormous. Microsoft went through this in the early 2000s. The stock went nowhere for a decade. But here's what really keeps me up at night. The leverage in the system. Amazon has created an entire ecosystem of third-party sellers, delivery contractors, and warehouse workers, all dependent on their platform. 3 million active sellers, 400,000 delivery drivers, 1.5 million warehouse workers. When Amazon sneezes, millions catch pneumonia, and Amazon's about to catch the flu. They just announced they're raising seller fees again, 15 to 20%, average take rate going to 17 to 23%. You know what happens when you squeeze your suppliers that hard? They find alternatives. Walmart Plus, Target Plus, direct-to-consumer Shopify stores. The alternatives are multiplying. Charlie Munger used to say, the big money is not in buying or selling, but in owning and holding. But he'd always add, provided you're holding the right things. Amazon isn't the right thing. Not at these prices, not with these fundamentals, not with this competition. It's become a value trap dressed up as a growth story. The worst kind of investment. Let me paint you a picture of what's coming. First quarter 2025, AWS growth drops to single digits for the first time. Stock drops 20% overnight. Second quarter, retail margins go negative as competition intensifies. Another 15% down. Third quarter, FTC announces remedies in antitrust case, 20% more. By this time next year, Amazon's trading at $900, down 60% from peak. And that's the optimistic scenario. The pessimistic one, they lose the antitrust case, get broken up, AWS trades separately at $1 trillion valuation, and the retail stub is worth maybe $200 billion. Current shareholders see their investment cut by 2/3. Now some of you are thinking, but Warren, you missed Amazon the first time around. You admitted it was a mistake not buying it 20 years ago. You're absolutely right. I did miss it. But you know what? Missing a great investment is far better than making a terrible one. And buying Amazon at 43 times earnings with slowing growth and massive competition, that's a terrible investment. The risk reward is completely upside down. Here's something most people don't understand about retail. It's one of the hardest businesses in the world. Margins are thin. Competition is fierce. Consumer loyalty is fleeting. Technology changes everything every few years. I've watched hundreds of retailers come and go. A&P, Woolworths, Montgomery Ward, Circuit City, Borders, Radio Shack, all former giants, all gone. The graveyard of retail is littered with companies that were once different this time. Amazon's not immune to these forces. They're just better at pretending they are. Look at what's happening in China. JD.com does everything Amazon does at a fraction of the valuation. Alibaba's cloud business is growing faster than AWS in Asia. PDD Holdings just reported revenue growth of 94%. 94%. These companies are coming to America. They're already here, actually. And they're eating Amazon's lunch on price. When Chinese competitors can deliver products directly from factories at 50% less than Amazon's prices, how exactly does Amazon compete? By losing more money? By squeezing sellers harder? By raising Prime membership fees again? Speaking of Prime, let's talk about that supposed moat. 180 million Prime members sounds impressive until you realize that growth is stalled. Renewal rates are declining. Young consumers are choosing Walmart Plus or just buying direct. The Prime video content spend $60 billion over 5 years, has generated exactly zero profit. Zero. They're literally lighting money on fire trying to compete with Netflix and Disney. It's the classic conglomerate trap, trying to be everything to everyone and ending up being nothing special to anyone. You want to know what really successful businesses look like? Look at Costco. Simple model. Low prices, high volume, treasure hunt experience. Membership fees provide all the profit. They don't try to make TV shows. They don't launch satellites. They don't lose billions internationally. They just execute their model perfectly year after year. Costco's stock has outperformed Amazon over the past 3 years. Think about that. A boring warehouse club beating the supposed king of tech. That tells you everything about where we are in the cycle. Here's another parallel that should terrify Amazon shareholders. In 2007, everyone thought financial engineering was genius. Lehman Brothers, Bear Stearns, they were masters of leverage and complexity. Then the music stopped. The companies that survived were the simple ones, the boring ones, the ones you could understand. Amazon's become so complex that even analysts can't properly model it. When you can't understand how a company makes money, that's not innovation, that's obfuscation. And obfuscation always ends badly. I learned something from my worst investment ever, Berkshire Hathaway itself. I bought a failing textile company out of spite and spent decades trying to transform it. The lesson? When you're in a bad business, get out. Don't double down. Don't hope for transformation. Just get out. Amazon's retail business is a bad business getting worse. And they're doubling down on it with grocery stores, healthcare, and satellites. It's Berkshire Hathaway all over again, just with better marketing. The numbers are stark. Return on invested capital at Amazon, excluding AWS, is now negative. Negative returns on capital in the retail business. You know what that means? Every dollar invested in retail destroys value. They're literally better off returning cash to shareholders than investing in growth. But they won't, because growth is the story. Without the growth story, the multiple collapses. And when the multiple collapses, the stock collapses. Let me tell you about a conversation I had with Charlie back in 2019. We were discussing Amazon, and he said, "Warren, any business that has to reinvent itself every 5 years isn't a business, it's a speculation." He was right. Amazon's constantly pivoting. Bookstore to everything store. Retailer to cloud provider. Cloud to advertising. Advertising to healthcare. Healthcare to satellites. That's not evolution. That's desperation. Great businesses don't need to reinvent themselves. Coca-Cola's been selling the same sugar water for 130 years, very profitably, I might add. The institutional ownership tells the real story. Vanguard and BlackRock own massive positions because of index inclusion. They have to own it. But look at the active managers. Berkshire, 0 position. Fairholme, 0. Markel, 0. The smart money's been heading for the exits, while retail investors pile in thinking they're buying the dip. You're not buying the dip. You're catching the falling knife. Now, let's talk about what happens when this unravels. And it will unravel. It always does. First, the growth investors sell because growth is slowing. Then the value investors sell because there's no value at these prices. Then the index funds rebalance as the market cap shrinks. Finally, the retail investors capitulate at the bottom. We've seen this movie before with GE, with Intel, with IBM. Former tech giants that lost their way and took investors down with them. Amazon's following the exact same script. The clock's ticking, folks. Every quarter that AWS growth decelerates, every quarter that retail margins compress, every quarter that international losses mount, the day of reckoning gets closer. My guess? We're 6 to 12 months from the first big leg down, 12 to 18 months from the full repricing. By 2027, Amazon will be a $600 to $800 stock. That's a 60 to 70% decline from current levels. And that's if they don't get broken up. If they do, could be worse. You know what you should be doing instead of buying Amazon? Look for businesses with actual moats. Businesses that generate real cash flow. Businesses you can understand. Railroads like BNSF that we own at Berkshire. They're boring, but essential. Utilities like Mid-American Energy. Everyone needs electricity. Insurance companies like Geico. Predictable premiums and float. These aren't sexy businesses. They won't make you rich overnight, but they won't destroy your wealth either. And in the long run, not losing money is more important than making money. Charlie had another saying I love. It's waiting that helps you as an investor, and a lot of people just can't stand to wait. Well, I've been waiting for Amazon to reach a reasonable valuation for 20 years. I'm still waiting. And I'll keep waiting because patience is how you avoid disasters. The market's offering you 4 to 5% risk-free in Treasury bills right now. Take it. Sit in cash. Wait for better opportunities. They always come to those who wait. Here's what nobody on Wall Street will tell you. Amazon's best days are behind it. The everything store concept has run its course. AWS is facing brutal competition. The conglomerate model is failing. The stock price just hasn't caught up to reality yet. But it will. It always does. And when it does, a lot of people are going to lose a lot of money. Don't be one of them. I've been through the 1,973 bear market, the 1,987 crash, the 2000 tech wreck, the 2008 financial crisis, the 2020 pandemic. Each time, the companies that seemed invincible before the crisis were the ones that fell the hardest during it. Amazon set up to be the poster child for the next crash. Too much debt, too much complexity, too much competition, too high a valuation. It's a perfect storm brewing. The smart money knows this. That's why Jeff Bezos himself has sold over $13 billion of stock in the past year. $13 billion. The founder and executive chairman is cashing out. What does he know that you don't? Mackenzie Scott, his ex-wife, has sold or donated most of her Amazon shares. The insiders are heading for the exits while retail investors are piling in. That's not a bullish signal. That's a 5-alarm fire bell. But here's the thing about bubbles. They can last longer than you think. Amazon could trade sideways for months, maybe even rally to new highs briefly. The market can stay irrational longer than you can stay solvent, as Keynes said. But eventually, fundamentals matter. Eventually, cash flow matters. Eventually, competition matters. And when that eventually arrives, the repricing will be swift and brutal. Let me share one final story. In 2001, I was at a dinner party in Manhattan. A young hedge fund manager, probably worth $50 million at the time, was lecturing me about how I didn't understand technology, how Amazon was going to take over the world, how brick and mortar retail was dead. He had his entire fund in tech stocks, mostly Amazon. By 2003, his fund was gone. He was working at his father-in-law's insurance company. The market has a way of humbling everyone who thinks they've figured it out. And right now, Amazon bulls think they've figured it out. They haven't. So what's an investor to do? First, if you own Amazon, sell it. I don't care if you're down 20% or up 50%, sell it. Take your money and put it somewhere safe. Treasury bills, high-quality dividend stocks, Berkshire Hathaway if you want exposure to well-run businesses. Second, avoid the entire big tech complex. They're all overvalued. Apple at 30 times earnings, Microsoft at 35 times, Google at 25 times. These are mature companies trading at growth multiples. It doesn't end well. Third, be patient. The best opportunities come during crises. When Amazon's trading at $800 and everyone's saying it's going to $400, that might be interesting. Not at current prices. Remember that friend from Nebraska I mentioned at the beginning? I called him yesterday. Told him exactly what I'm telling you. He said his broker thinks I'm too conservative, that I'm missing the AI revolution and the cloud transformation. Maybe I am. But I'd rather miss an opportunity than lose my shirt. And right now, Amazon looks like a shirt-losing proposition. The collapse is coming, folks. Maybe not tomorrow, maybe not next month, but it's coming. The math doesn't work. The competition's too fierce. The valuation's too high. The business model's too challenged. When everyone's running in one direction, that's usually the time to walk the other way. And right now, everyone's running toward Amazon thinking they're buying it cheap. They're not. They're buying it expensive, very expensive. And expensive purchases rarely end well in the stock market. I'm 95 years old. I've seen a lot of markets, a lot of bubbles, a lot of crashes. And I can tell you with absolute certainty that Amazon today looks exactly like every doomed market darling I've ever seen. The same hype, the same valuation metrics that don't make sense, the same dismissal of competition, the same "this time is different" narrative. It's not different. It never is. And those who don't learn from history are doomed to repeat it. Amazon shareholders are about to learn that lesson the hard way. Now, if you'll excuse me, I have a cherry Coke to finish and some annual reports to read. Companies with actual earnings and reasonable valuations. That's where the real opportunities are, not in falling knives like Amazon. Stay safe out there, folks. And remember, the first rule of investing is don't lose money. The second rule is don't forget the first rule. Amazon at these prices breaks both rules. You've been warned.